Welcome to this video on S&P 500 trading. This one is very interesting, one of the most really powerful things that I have come across, and so let's dig right in. This is especially good for swing traders and ways to potentially outperform the S&P 500, which is the benchmark that most funds use and so forth. And of course, as you probably know, very few people, very few funds outperform the S&P 500. So if you can do that, you're already in the top echelon of traders. So here's one way to attempt to do that. No guarantees, of course, but here's a way that one technique that I use that works very, very well for me. So take it, try it, and here it is. So what we have here is a little bit of an unusual chart for most people, I would say. And if you look over here, we don't have any prices. We have percentages. And so that's because we're using a chart that is a percent change chart. So what it does is it starts, I have to start 90 days ago. So when it starts on the left-hand side of the chart, that's 90 days ago, 3 months. And then, of course, it starts at 0. I don't know if you can see that really thin yellow line, but that starts at 0. So, of course, on day one, it has 0 change. So then as we begin, going after the very first day that we begin, then it's going to go above or below. And that tells us the percentage change that that market has had. Okay, then we're going to compare it. So anyway, you can tell as of this last day on the chart here, the S&P's been up 5.484%. Okay, and that's the black line. The black line on here is always going to be the S&P 500. Now, then I use another line and I plot another market. In this case, it is the Russell 2000. And so what we're doing is we're comparing the percentage change between two markets. So here's the shift, and this is what we're looking for, is the shift where now, again, remember this magenta line, this purple line is the Russell 2000, and it shoots above the S&P 500. And now it is almost made twice as much money on a percentage basis than the S&P 500, 5%, 10%. So that's great. Okay, now that's the easy way to read it. That's the beginner's way to read it, and not necessarily the best way. So you could look for simple cross of the two markets here. All right, that's one way. Another way is to use an indicator like this, which is just a simple mathematical formula. It's called the spread, or sometimes it's called the difference, and all it does is it measures the difference between these two lines. So you make one as the major one, and then the other as the secondary one. So what we're doing is we're really, in this case, we're going to have on all of our charts the S&P 500. So that's going to be our standard, and we're looking for a market that may outperform it. So we're going to have this line have the dominant market be our comparison market. So if you look at this, what you see is that this line is going down, 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 down. And that means, of course, that our secondary market, the Russell in this case, is underperforming the S&P. Then we're looking for a shift. So this will give us a little earlier reading, potentially, where if we could draw, for example, a trend line here, and as it breaks that trend line, get in there, and then potentially get in a little bit earlier here instead of here. And that gives us more profits. We're getting in earlier. Another thing you can do is you can draw horizontal lines like this. That gets you in about the same time at this point. Okay, so that's all great, gets us in a little earlier. Now let's compare with some other markets. So we could go through the major indices and go to the Nasdaq composite. Now here, again, the black line is the S&P, the magenta line is the market we're comparing it to, in this case, the Nasdaq composite. It's underperforming. It's only made 3.9% as opposed to 5.4%. And now you notice the difference line is just kind of going sideways. And it had gone up. Now, this looks weird. It looks like they're in lockstep here, and they kind of are, but the key to this, the way you have to look at this, is that the spread, actually I like calling this indicator the spread indicator. The spread between the two lines is that distance there, which is bigger than that distance here. So if you would have bought here, you would have made more money than if you had bought the S&P at this time. In other words, if you bought the composite, even though the magenta line is still under the black. And that's why, if you bought this, breaking this high here or this trend line here, you would have made money because it's closing the spread. And therefore, during this period of time, it's catching up. Now, in this period of time, it's losing ground again, and that's why this thing goes down. And the spread between the two lines is much bigger. So a lot of it depends on when you get in, when you get out. These things are in flux, just like everything in the market. There's a dynamic flux of up and down. And so it's not always a long-term strategy. It's a swing trading strategy, which is holding overnight, but for short periods of time. All right, let's look at a couple of other markets just out of interest. So now if we go down here, you can do this, for example, with just deciding, well, what do I want to trade? All right. So, for example, right now we've got great opportunities with, we can trade currencies, but if you don't want to trade spot forex, you can always trade, and you can do this with spot forex. You can do it with futures. You can do it, in this case, with ETFs. So you say, well, maybe I want to invest in currencies. Well, probably not so much right now, at least, because here, again, it's all about timing, right? So here, it's underperforming. That's the magenta line. That's the euro. And then it caught up. And when we broke that line, yes, you would have made more money buying the euro than buying the S&P 500. And then we get another shift, again, crossing of the lines here, breaking of the trend line here. And then you would be like, nope, don't want to be in the euro anymore. Now I want to be back in the S&P. So here's a comparison with the emerging market exchange trading fund. And a lot of people like emerging markets because they say, oh, well, these are early in their economic cycle, their growth cycle. And there's definitely validity to that. But these markets don't always outperform. And so we want to know when they're going to. Timing, again, it all comes down to timing. And then trade them or invest them. So how do we get some indication as to when that might occur? Well, during this time, these markets are pretty much moving in a similar way, the S&P in the emerging markets, and that's seen by the spread indicator just kind of going sideways here. So what the opportunity is, we look for it, again, the cross of the lines, but more specifically, I like to look for this breakdown here of the support. So that's the key. That's where, okay, now we're getting a shift where, in this case, the S&P is outperforming and it's going up a bit, but the emerging markets are going down dramatically. Then we get another period here where they move kind of in a lockstep, and then again, another breakdown occurring there. And that's where you could go short. Now, see, that's the thing. To outperform the S&P 500, you don't always have to be buying something that is doing better on a percentage basis, being more bullish, in other words. So you can get a little tricky and say, hey, I'm going to short markets that are going down more than the S&P is going up. And that's another way to potentially financially outperform the S&P 500. So another different little perspective on it if you're comfortable with that. If you like this video, please understand, yeah, it's free, but if you got value from it, you have a moral obligation to pay it forward by clicking on that little share button below and share it with your friends and family on social media. Believe me, it'll give you a warm feeling in your heart that you did something nice. Also, if you're watching this on YouTube, please click the thumbs up icon below and leave a comment because I really love to hear from you, and that encourages me to create more free tutorials for you. Now, I want to really point out a special offer that I'm giving away, my favorite trade strategy. It's called the rubber band trade. I'm going to give it to you absolutely free. And it's a simple trade. I can teach you to in about 26 short minutes. So you can get that video explaining that trade strategy absolutely free by clicking on the image in the top left corner, or if you're on a mobile device, then click on the little eye with a circle around it in the top right corner of this video. And if you're not watching on YouTube, then there's probably a link below or an opt-in form on the side. Once you do that, I will personally email the video to you with the rubber band trade strategy.